Bright lights.
All right, looks like we're back in business here. Welcome back, everyone. We are the last panel for the afternoon. So if you had a cookie outside during the break, that should last during this whole panel, that sugar rush. So we're hoping you all stay awake. Again, my name is Carlos Alcazar. I am the Chief Operating Officer at NCST. And our panel is going to be looking at the state of REO and distressed defaulted and mortgage properties. We've got a couple of different perspectives on the panel. And obviously, how can we create homeownership opportunities through the various disposition methods that we'll be talking about. So I'm going to introduce each of our panelists. Again, for those that are online, there's a much longer bio. I've got a shortened bio for everybody. So Molly Basil, on my left, is Principal Economist in the Office of the Chief Economist at CoreLogic. She is responsible for analyzing and forecasting housing and mortgage market trends, including the single-family rental market. She has a depth of expertise in mortgage market analysis, model development, and risk analysis in the housing finance industry. Molly previously worked at both Fannie Mae and Freddie Mac, providing forecasts and analysis on the housing and mortgage market. Next to Molly is Melissa Bussey. Melissa currently serves as Executive Principal of Client Relations and Business Development at Xome. In this role, she is responsible for functions of business development and client management, including portfolio performance, process improvement, special projects, and industry relations. She's an ardent supporter of equal and transparent access to homeownership and is a champion for affordable housing initiatives at Xome and beyond. And next to Melissa is Matt Martin, who is Senior Vice President for Subservicer Oversight at Lakeview Loan Servicing and has over 30 years of experience in the mortgage industry and has a wealth of FHA servicing and loss mitigation policy knowledge. He began working with Lakeview earlier this year as Senior Vice President in the Subservicer Oversight Division. Obviously, I've already said that in his title. He recently retired from HUD after 22 plus years, where he was Director of the HUD National Servicing Center in Oklahoma City. And last but not least is Marlene Robinson, who is a Senior Program Advisor in the Office of Asset Sales within the Office of Housing, Finance, and Budget, U.S. Department of Housing and Urban Development. In her capacity as Program Advisor, Ms. Robinson manages disposition of HUD's commercial assets, multifamily and healthcare loans, overseeing all aspects of the sale of these defaulted notes. In addition, she provides advice, guidance, and oversight in the planning and execution of the sale of FHA single-family defaulted mortgage notes. So I'm excited about this panel because we're the last ones, right? First of all. And second of all, they're all start with the letter M. So this is the M panel, okay? And it's just, we've been talking about toolkits and tools that we can use in this crisis that we're in. And this is one of the last ones, right? So we talked about programs that are available for purchasing homes. We've talked about federal policies. Now we're talking about where's that inventory or where has it been and where it might be coming from. Our panel is going to be a little bit different. Each panelist, except for Matt, has some slides that they'll go through, and then we'll ask some questions. And obviously, we'll have a Q&A for the last 20 minutes. QR codes on on the tables or up on the screen. Ask them, and we'll ask the panelists for it. So with all that being said, Molly, you're up.
All right. So I guess we're the first ones with slides.
Absolutely. Yes.
We're gonna keep you on your toes here.
Yep.
So I'm going to talk about a few things. I'm going to talk about just how many foreclosures are out there right now. I'm going to talk about why we would think about foreclosures as a source of affordable properties. What the pipeline is into foreclosures and what's kind of holding some of it back and who's maybe some competition for this. Don't worry, if you can't see everything, I'll walk through it. I think we have these available later. Yeah. So here I've got pre-foreclosure sale or pre-foreclosure filings. That's when a public notice has been made of the foreclosure and completed foreclosures. The top line is pre-foreclosure filings. You'll see I've gone all the way back to the foreclosure crisis, so you can see just how many there were back in 2009, 10, 11. These are monthly numbers. Some months are greater than 200,000 pre-foreclosure filings a month. That took quite a while to come down. You see a big drop off there during the pandemic and slowly been climbing up. August this year is our latest information. 32,000 pre-foreclosure filings. That's about 75% of the monthly levels of 2019. So that's coming back a little bit. Completed foreclosures, you'll see those are less than pre-foreclosure filings. This doesn't include my completed foreclosures, doesn't include short sales. This is where the house is taken by the bank, sold at auction, or if it's not sold at auction, at least the homeowner has lost the home to foreclosure. Again, you'll see the same kind of pattern, over 100,000 per month back during the foreclosure crisis, big drop off during the pandemic, and only about 9,000 per month right now. That's about half of what it was in 2019. So still coming back with the completed foreclosures. This is all public records data, by the way. So why would we care about foreclosures as a source of affordable lending? Well, distressed sales, here I'm showing distressed sale median price as a ratio of healthy sale median price. Distressed sales, I have REO sales and short sales both in here. And healthy sales are just everything that's not distressed, and healthy and REO sales or short sales and REO sales. Typically are about 60% of healthy sale price. So that is a more affordable. You'll see that in periods of distress, like the foreclosure crisis, that gap kind of narrows, just all prices are falling at that point. So we do have that kind of narrowing of the gap there, but pretty consistently, other than that, around 60% of a healthy sale price. But so I talked about that kind of low level of foreclosure that's out there right now. What about that pipeline into foreclosure? Serious delinquencies, that's 90 plus. These do include foreclosure. And 6 months or more past due, that's your later stage of foreclosure. So maybe a little harder to recover from that even. Serious delinquencies, again, I go back to the Great Recession foreclosure crisis, topping 7% of mortgages were in serious delinquency. You see, we had some pretty low levels in 2019. COVID hits, these are still late. They might not be reported to credit agencies, but they're still late. And coming down August 2023, 0.9% of mortgages in serious delinquency. We tracked this number back to 1999. That is a record low. So very few loans in this later stage of delinquency, even fewer when you get to the 6 months or more past due. But again, I include that on there because these were the ones you might see flow into foreclosure, but there's only about 130,000 borrowers right now who are 6 months or more past due. So very low levels. Let's look at the pipeline at kind of the earlier stages, 1 to 3 months past due. This is all the same story, 4 to 5 months past due. After the recovery from the pandemic, it's pretty low levels. So we've got just a really strong economy right now. We've got job growth, jobs still growing, or jobs are still being created. Unemployment rate, even though it's up a tiny bit, it's still under 4%. So when people have jobs, they can pay their mortgages on time. So that's not rocket science, I guess. But that's just, we're not seeing a lot of the pipeline is pretty low right now. So when people do go into these later stages of foreclosure, what's something that's keeping them from, later stages of delinquency, what's keeping them going into foreclosure? Well, something we didn't have back in the Great Recession, the foreclosure crisis, was high amounts of home equity. On the chart on the left, I've got the average amount of home equity per borrower. So these are just mortgage loans. $289,000 per borrower. So the average home borrower has $289,000 of home equity. That is quite a bit. So that if they should head into those late stages of foreclosure, maybe there's even a pre-foreclosure filing, maybe they could just sell their property in most cases and not end up losing their home, which helps them with their credit as well. They don't have the foreclosure on their credit. I like to put the negative equity share on there because back during the Great Recession, we had 26% of mortgages were in negative equity. They owed more on their mortgage than their home was worth. And now that's around 2%. So we like to think about, home prices are slowing. I don't know that I've seen any forecasts right now for declining home prices, and if they are, it's just it's just a tiny bit. CoreLogic's got home prices growing around 4% for the next year. But what would we have to do to get back to that 26%? Home prices would have to fall by about 40% to get back up there. So we're not headed back up there. We're not headed back up to those huge amounts of foreclosures either. So, but we still have some out there. So say we do have a home go into foreclosure. What's something that's keeping it from getting to what I'll call a regular buyer or a non-investor, right? And that's investors are buying right now. Nearly 1/3 of all sales are going to investors. And these are, again, public records information. These aren't mortgages, these are sales. So a lot of times investors don't have a mortgage or not a traditional mortgage, some other kind of financing. Typically that investor's share would be around 15%. And we have a level shift there up during after the pandemic. And now it's bouncing around high 20%. When rates increased in early 2022, we did see that drop a little bit, but it's just right back up there. Again, a lot of these are not using mortgages. Okay, so investors buy a home, maybe they flip it and put it back out on the market for sale. Now, not typically. Only 15, well, less than 20%. It bounces around, but flipping activity is very small. This is the share of investors selling within 6 months, and it's typically always under 20%. Q1 2023, that's our latest, since we have to wait 6 months. 13% were flipped, so it's incredibly low. What are investors doing? They are renting them out. As Carla said, I track the rental market. Rents are up just like home prices are up. Investors are really attracted to community or metros that have really high rent growth, and they are buying in there. Not necessarily driving up the rents, but coming into those areas with the high rent growth. So again, to recap, we got low foreclosures, low pipeline of foreclosures. Part of that is the great economy we have, so that's the good news there. But then we've got some competition here from investors for those foreclosed properties.
Great, thanks, Molly. So, I wanted to ask you a couple of questions. On your one slide, it dawned on me, the home equity slide. So right now at 289,000 of equity in these homes. Obviously, we've been talking about how important it is to become a homeowner. Had somebody bought a home a few years ago, they would obviously have a lot of equity into their home. But that's not normal, right?
No. So we hit a high there last year. There was a high, might have gotten up to 300,000. I can't remember. It dipped down a little bit. Yeah, that's if you were to track that.
What is normal? What would you normally see? Because it is your single biggest investment, and are you getting a good enough return over the years?
Yeah, I think a home buyer could expect reasonably a 5% return per year. Much more than that right. They shouldn't count on it.
But these levels are going to stay where they're at currently. You suspect?
Yeah. So we don't see home prices falling anytime soon.
Okay. So you talked about the low delinquency rates in recent months and how that correlates with the strong labor market. Thank goodness we have that. But what is your projection for delinquencies if unemployment should increase, which really would be bad? But what if it does?
Right. So I look at some forecasts. Unemployment, so it's a little under 4% now. Forecast I'm looking at, it goes up to high 4%. So it's still even though it's projected to increase, not up to any high levels. So if we had that unemployment go up to 4.75% over the next couple of years, we'd see that serious delinquency rate that I showed of 0.9% go to about 1.9%. So not a huge increase, but that would have some more flowing into the could be into the foreclosure pipeline.
Right. Great. So what about again, the large investors? You had a slide up on there. From an economist perspective, how can home buyers compete against large investors?
Yeah, so I think I should point out, I think a lot of investor numbers have been thrown around today.
Yep.
So some are they show low numbers. We show I don't know if ours are high, but about a third. Our investor definition is any person or entity owning 3 or more properties at one time. So you go all the way from the mom and pops of 3 to 10 properties, all the way, you got a couple in between there, but we have what we term mega investors, which are 1,000 or more. So that could be your institutional investors. The mom and pops, the 3 to 10, they are buying, I don't have the stock numbers, they're buying about half of those. They're about half of those investors. So, a lot of times they're going to be, coming in with a mortgage. So they're a little different. With the high, and then you've got the 10 or the 11 to 100, they're like another 30-40%. So they're probably got some different financing. But it's the mega, it's the greater than 100 or the mega that are, I think, probably the biggest competition. Again, they're coming in with cash of some kind. They're wanting to play at that lower end of the price. So just any way that a buyer could come up with some financing that, or like they already have their mortgage approved, or they have some other kind of financing.
Got it. But this is not, this, from your data, is it concentrated in certain areas? I mean, it's not necessarily a national problem, right? Where you've got investors that are going to buy all throughout the country. Is it, you see it concentrated in certain markets?
Yeah, there are certain markets. So some of the really expensive markets, the investors don't go in. I have one exception, which is San Diego. They're really interested in San Diego, so I'm not sure why. Maybe the military base. But yeah, typically the lower price. Arizona is popular. A lot in Texas is very popular. So, but yeah, it's not necessarily a nationwide problem. Some place like Boston would hardly have any investors.
Great. Okay. Well, thanks, Molly.
Sure.
Melissa.
All righty. So first, I have to probably teach everybody how to say our name. So I always tell people Xome, just think of home with an X. So Xome is a real estate marketplace, an online auction platform for distressed inventory. And our goal is to make home buying, home selling, home investing as easy and transparent as possible through our online auction platform. We also have one of the largest search engines in the industry, home search engines. So think Zillow. We have all kinds of tools on our website to not only attract people to our website, right, but also for homeowners and investors to perform due diligence on our site directly. So we have things like after repair value. We have things like school ratings. They can pull look at comparable properties while they're researching to purchase a property. So that's a little bit in a nutshell about Xome. Now, Xome, we say keeping the dream of homeownership alive. We are supportive of all first look programs. The biggest by far, of course, is the HUD CWCO First Look program. I think Marcos referenced earlier the California First Look program. We're also involved with that. First Look programs as implemented by the GSEs as well. But by and large, HUD CWCOT First Look program is something that Xome was very supportive of from the beginning. So we identified that we needed a partner for that. So I think it was September 2021 that the Biden administration's affordable housing plan was released. And we forged a partnership with the National Community Stabilization Trust as part of, to carry out the plans within that affordable housing plan. The goal within that was applicable to Xome is the goal was to create, preserve, and sell 100,000 properties over the next 3 years. Of course, this was September 2021. This is how fast time passes. Here we are up against the deadline, September 2024, 100,000 properties. Here we go.
We're not close, are we?
So it's a lofty goal, but a noble one. And we're very appreciative of the partnership we have with NCST. They help procure buyers, nonprofit buyers, and government entity and other mission-based buyers for Xome. So since the partnership was initiated, we've transferred 3,400 plus properties over to NCST so that they can make those properties available to their buyer network. Just a few quick facts about Xome: 115,000 properties sold since 2013, 25,000 assets under management. One thing that we are proud of, 1.5 million site visitors each month to Xome.com. It's something we keep close track of. 5,000 new account creates monthly, and all just 60% of our closed files are from first-time users. That's intentional. We are trying to attract local investors. We're trying to attract homeowners as well when it makes sense for that homeowner, especially through the First Look program. And I mean, I'll take it a step further. 49% of our buyers only buy one property from Xome and never return to Xome. Now, you would think that would be bad, right? But that means that our target marketing is working. We're trying to reach that local investor or homeowner. About 24% of our buyers fall into that mega, 11 plus properties purchased through Xome. So it's a much smaller percentage. So real quickly, I'll just kind of go through the waterfall of solutions that we offer. The first, and think of this as going from loss mitigation all the way down to an REO scenario. So Expert Seller is a program where we partner with our mortgage servicing clients who have borrowers who have told their servicers that they would like to or they need to sell their home. So it is Expert Seller is a solution that avoids foreclosure. So that servicer warm transfers that borrower over to Xome. Xome walks that borrower through their options of either a traditional sale or an auction sale. We then partner that borrower with a local real estate agent who then sets expectations on sales price for that homeowner. And then we facilitate the sale of that property. So it's preserving equity, avoiding foreclosure. We also just launched the Expert Seller program with a large reverse mortgage servicer, which I'm very excited about because we're not only offering the Expert Seller program to borrowers, but also to heirs. So as you know, in reverse mortgage scenario, the heir has an opportunity to preserve equity. And so we're partnering with that servicer to try to do that. Next in the waterfall is, unfortunately, foreclosures sometimes must happen. And so Xome facilitates the foreclosure sale in all 50 states and US territories. I think we call the sale in 29 states, meaning we call the foreclosure sale. And then in the balance, we do marketing only services. And that inventory, I think the average sales price for our foreclosure sales is under $200,000. So it's a good source of affordable housing supply. And then that rolls into anything post foreclosure, rolls into almost all of our properties roll into some sort of First Look program where eligible properties are reserved for 30 days and marketed to homeowners, approved nonprofits, and other mission-based organizations for the first 30 days. And then after First Look, after that first 30-day period, it rolls into a traditional CWCOT second chance or REO scenario where bidding is open to any buyer. So that's sort of the waterfall of our solutions. And then I'll go over this quickly. This is just a closer look at our exclusive First Look access. As I mentioned, this was in response to First Look was in response to HUD Mortgagee Letter 2022-08, whereby all FHA loans roll into an exclusive First Look access for the first 30 days. So 0 to 30 only, and here's a key differentiator with the CWCOT program is it's HUD approved nonprofits, government entities, and homeowners. In other First Look programs, the nonprofit may not have to be HUD approved, but in this one, of course, it does. And then, so after the 30th day, then bidding opens to the general public. So this is just a few success stories on First Look. The properties that you see to my left, to your Our owner occupant purchases, so you can see they're all under $200,000. Again, good affordable source of affordable housing supply. Off to the right is 2 government entity purchases that NCST helped procure and a HUD-approved nonprofit purchase. 62% of all the properties sold through First Look have been vacant. 83% of those have been owner occupants. That number changes on a monthly basis due to the lower volume that's being pulled through. As you can see, 100+ properties sold during First Look since August 2022. And that's a long way away from 100,000, although that 100,000 number is obviously in collaboration with other efforts as well. But so I'll just say the challenges, now that we've been a full year into First Look, the challenges with the First Look program are first and foremost the occupancy, right? 60+% of all foreclosure inventory are occupied assets. Well, if you're a homeowner, that's going to be difficult for you to sort of navigate. And if you're a mission-based organization, that also may be against your mission. You're not necessarily interested in evicting homeowners. So occupancy is the biggest challenge with First Look and a reason why more properties are not sold during First Look. The second is access to financing. If a property is occupied, you're not going to have access to financing. There's a big gap there. And then the third would be, and Commissioner Gordon prefaced this earlier, is the eligible buyer list is narrow, right? That it only includes HUD-approved nonprofits, government entities. We see that there's opportunities to expand that list through I'll detail that a little bit later.
Great. Thanks, Melissa. So I think one question on my mind has always been, why did Xome decide to kind of forge this relationship and start working on affordable housing initiatives? Because you're one of the largest auction platforms, and you've got different kind of investors that we have. So why did Xome take on that initiative?
So I mean, we've always, even before the mortgagee letter was rolled out, our motto was keeping the dream of homeownership alive. We've always seen our inventory as a source of affordable housing supply. And so honestly, when the affordable housing plan rolled out from the Biden administration, and I saw that that we were going to get support to carry out that mission. I mean, we were excited about it. It was an opportunity to get more of our assets into people's hands that need it.
Great. So if I'm a buyer or someone who wants to purchase a property, how do I gain access to your inventory?
Yeah, so it's pretty simple to sign up to be a buyer on Xome.com. It's free, of course. You go to our site, you create an account. You can set up your search parameters. We have an investor relations group who is dedicated to reaching out to you as a new user, that will then take your criteria. Where do you want to buy at? What value range do you want to buy? What are you looking for? And we develop a relationship with our buyers. But it's very easy to transact. We even have tools on our site that help you get familiar with bidding. So we have an auction simulator that we just released that's, if you have an extra 10 minutes to play a game, you can go to Xome.com and there's an auction simulator and you can actually get yourself used to bidding in a live auction.
But the CWCOT access is completely different, right?
Yeah, the CWCOT assets, are you talking about like First Look? Yeah, it's definitely different. It's not, in most cases, it's not an online auction format. You're going to an actual live foreclosure sale. Yeah.
So what issues, initiatives does Xome support as it relates to improving access to distressed affordable housing supply?
Yeah, so I started to go into it earlier, but just there needs to be a better vetting process for nonprofits. We're supportive of the utilization of a third party to vet buyers like NCST, who can approve these buyers for participation within First Look, and then not only approve them, but follow through on measuring the outcome. What happened? What ultimately happened to that disposition? Did it create a home ownership opportunity, and help craft that story? And then also, I mean, if a third party is utilized like that, potentially considering for-profit mission-based entities. Yeah.
Yeah, when
And then-
the commissioner was talking about that whole process, we had a nonprofit at our table kind of grunt about the whole process because they'd just gone through it. It is
Yeah.
it's a little daunting for sure.
Yeah, there's
And Matt knows about it.
173, yeah, right. There's 173 HUD-approved nonprofits, and a small percentage of those,
Yep.
nobody knows that better than you, participate in First Look. So definitely need to expand that list. And then Commissioner Gordon also, and David Sanchez referenced modifications to the 203K loan. We're in support of that. Perhaps those modifications can help bridge the gap in financing as well.
Right.
That's a real problem.
That's great. All right, thanks, Melissa. So Matt, let's talk about what Lakeview is doing.
All right, so I'm the no slide person, so I'll be the one off on here. But so if you think about it, so where's the inventory sitting? I mean, and Molly covered a lot of things as far as low delinquency rates, foreclosure starts are down, things like that pre-pandemic. But COVID loss mitigation was, some people say it was too good. Not sure I agree with that, but it was very good. I can remember back when the pandemic first hit, and I was at HUD, we were scrambling, what can we do to help people, because people were losing their jobs or their employment was shutting down, things like that. So what can we do to keep people in their homes? So, a lot of loss mitigation came out with forbearances. Forbearances got extended, so that helped people that had income reduction or income that no income to stay in their properties. Otherwise, there would have been a massive foreclosures, probably similar back to 08 and 09. So very beneficial from that standpoint. The loss mitigation tools that were put out were very good. The partial claims by HUD are a junior lien on the property that takes care of the arrearages and allows the borrower to resume their normal monthly payment and pay that partial claim back later on when they sell the house, carries no interest rate. So it allows them to stay in the house. And so the partial claim was out there. The loan modifications, obviously loan mods are not real great right now because of interest rates. So you're not going to get payment relief from that. So I know a lot of the agencies right now, we're kind of watching because they're going to come out with some additional things. I think probably VA, USDA, and FHA here, hopefully in the next week or two, that will come up with some solutions that will allow for payment reduction. Because we've got a lot of borrowers that have come off of forbearance, some borrowers that are still struggling, may have income back, but they don't have the same income they did before the pandemic. So, that is a problem. People, maybe had medical bills or things like that caused them to lose income. So I think these new tools that are going to come out, hopefully from the agencies, will allow for many borrowers to get payment reduction, which we all know that payment reduction allows for someone to avoid delinquency in most cases, and that's the most effective tool. So there are some additional loss mitigation tools that are going to be looked at. So I think, we saw earlier that the foreclosure starts are starting to come back up a little bit, but still way below from where they were. If you look at it, non-judicial states are typically quicker than judicial states as far as foreclosures go. So even if you, let's say that foreclosure started in 2024 early, it takes time for that property to go through that process. So it may not be available back into the inventory for, 5, 6, 7 months in a non-judicial state. A judicial state could be as long as 36 months in some areas back in the Northeast. So, I'm from Oklahoma, and I know our judicial process is at least 12 months. So even if foreclosure starts, the ones that are going to foreclosure start back up, we're still looking at some time before they come back into the inventory. So that's something to look at. And then if you look at it, so Melissa had mentioned the First Look program. So I know that, there are a lot of borrowers sitting out there with equity. So how can we, if those borrowers are just not going to be able to continue to make payments, how can we help them keep their equity and sell the property, keep their equity and avoid a foreclosure? So I think those are programs that are starting to be looked at. I mean, it's very difficult right now to convince someone that that's a good idea to sell their property, even if you have equity, because the question is, where do I go? So there's very low inventory. Rents, as were mentioned earlier, are going up and very high. So that's the question. So even if I walk out with $30,000 of equity, as opposed to going through a foreclosure, then, rates are at 7-8%. So I probably can't afford I may not be able to afford a new mortgage if there is any inventory for me to try to buy, and then I've got to pay a higher rent. So very tough situation from that standpoint. But I do think that, as Melissa mentioned, claims without conveyance of title, CWCOT, there is an opportunity for for home buyers, owner occupants, nonprofits, HUD-approved nonprofits, and government entities to buy during that second chance period. The first 30 days, those three entities have the right to bid on those properties before investors come in after that. So there is an opportunity for those properties and the ones that come through on inventory to do that. So there is opportunity to buy. I mean, I know, there's note sale opportunities that they've put in that have that first look period too, where they split the pools out. Marlene, don't kick me. I'm cutting on your on your subject, but I know the note sales. When I was at HUD, they carved out certain pools of properties for nonprofits only, which was advantageous also. So I think those are opportunities that are going to be out there. Assumptions, are another opportunity. People with 3% mortgages, an FHA mortgage can be assumed. If you have someone that has the equity to buy that equity, that's another option for somebody to sell their property, put the property back into inventory, assume the loan, and keep that 3% mortgage as opposed to try to go out and get a new mortgage at 7 or 8%. So I think there's opportunities from that standpoint also. Let's see what else. I think that's that's kind of it from a policy. I think the policies that we can do are out there. I think with FHA, VA, I think is going to come out shortly with a repurchase program where they're going to purchase the loans and take those back and be the purchaser. FHA is going to come out with probably some type of partial claim program where it allows payment relief through a partial claim that pays a portion of the principal portion each month. And I think USDA will probably follow with that too. So those are the big things that we're all looking for and anticipate that they'll be out in hopefully in the next couple of weeks.
Great. Thanks, Matt. So how can disposition options allow home buyers to have more access to properties first?
Well, again,
kind of talk about that a little bit.
Yeah, through the CWCOT program, as Melissa mentioned, they have these auction vendors have a very good, what do you want to call it, home buyer school or education program where they will show home buyers owner occupants what's involved in buying the properties, whether it's financing, cash, whatever. Some of the pitfalls, such as there may be rehab that needs to be done. So they talk to them about, checking title to make sure there's clear title after the foreclosure. Or talk to them about the closing process. I know a lot of the auction vendors will bring in home construction people to talk to them about things that you may need to do as far as repairs to properties and things like that. So I think having that first look period, and even HUD has that in the REO portion where they allow owner occupants and nonprofits to buy that first 30-day period. It gives those buyers the opportunity to get it before the investors try to purchase the property.
So the whole, the loss, you've got a pretty great background on loss mitigation. And so, it was occurring during the pandemic. You weren't here for the first part of the symposium. They were talking, I think, 8.5 million went into forbearance, and somebody is going to have to check my math during the pandemic. So 52% are performing. There's still some that are still coming out of it. Maybe walk us through where we are in that process. Are there still some that are in forbearance? Is it just the FHA portfolio? Is it, your portfolio that you have?
So the forbearances in all cases are pretty much wound down. The GSEs, I think, did deferments. They came out not too long ago saying that their COVID type policies were expiring, I think, in either end of October, first part of November, if I remember right. Pretty much HUD's forbearance is, all those should be done in November. They had extended it out several times, and I think the last time that you could go through and still have forbearance would be the end of November of 2023. So all those are going through the process. And so I think if you look at it, before the pandemic, HUD had 450,000 partial claims, which are the junior liens that people use to take care of their arrearage. When I left HUD, there were about 1.4 million partial claims. So that tells you how many they put on for loss mitigation through the pandemic. And there are some states that still have the HAF funds, the homeowner assistance funds, that have been able to use those funds to pay back the partial claims. So I think those are things that we've really pushed. States are allowing their homeowners to use those HAF funds to pay back the partial claim. So the borrowers essentially get some equity back. And so I think, we are going to have a percentage of borrowers, don't know what that is, but we are going to have a percentage of borrowers that are not going to be able to resume payments. Just doesn't make, just whatever programs are available, they've just lost income or their family situation. So, we used to call them short sales. They're not really short sales anymore, but they would be, they're starting to be talking programs where they can sell their property, avoid foreclosure, take the equity and go on down the road. And there may be some incentives given to borrowers that are willing to do that. So I know that there's been talk of, if a borrower is willing to participate in a program like that, maybe you give them a relocation assistance also of 5-10 grand or whatever to be able to make it a little bit better for them to transition to an apartment, another rental property or something like that. So I think that the CWCLT program, but anything that you can use to avoid a foreclosure on the borrower's record is obviously very beneficial. Assumptions, is another opportunity, I think, that is available on certain type loans.
Great. Thanks, Matt. So before we go on to Marlene, I want to let the audience know if you have any questions, go ahead and use the QR code that's on your tables. If you're here in the building online, use the QR code and submit your questions for any of the panelists. So Marlene, let's talk about what HUD's doing. And
Okay,
you need the
all right.
clicker, otherwise it's not going to work.
Oh, yep.
Appreciate that. Thank you, Matt. Okay, so what I thought I would do is take a step back to bring us forward. Because if there's one word that describes loan sales, since I've been in the HUD loan sales office since 2010, it's been evolution. We've evolved and we're continuing to evolve. So I'm just going to walk us back, but not belabor the past, and then bring us back to the present. So I'm going to give you a little brief history of the loan sale program, talk about DASP. Everybody has an opinion of it. And then bring us back to today, which is the HUD vacant loan sales and what we're doing with that in terms of supply and affordability. So loan sales have been around for a minute, since 1998, when the 601 accelerated claims disposition legislation was put in place. And this allowed HUD to pay a claim on a defaulted mortgage rather than convey the property to become, the lender would foreclose and it would be an REO that would be conveyed, then HUD would sell the REO, but rather than do that, back then they transferred the loans to a joint venture, and that joint venture service or restructure the loan or foreclose if it came to that. So between 2002 and 2005, there were about 4 of those joint venture sales. And then there was a pause in the program to kind of evaluate what it did and so on and so forth and how to move forward. The overarching goal of the program was to bring value and recovery to the Mutual Mortgage Insurance Fund. And it's still our overarching goal today, but I believe that we in loan sales have been able to meet that goal and at the same time also work on our mission objectives and incorporate that. So there was a pause in the program. Then it started back up in 2009 as a mortgage acquisition and disposition initiative, but nothing happened until 2010 when we did some really small sales just to test it out. And it was a pilot then, and it's still a pilot now, although we're working to make it a permanent program. So we did a couple of small sales that we dubbed Too Small to Fail. That was our director at that time. And but then we had the crisis that everybody knows about in 2008. And so, you know, HUD wanted to do something, FHA wanted to do something to help with that. And we expanded the program, rebranded it as DASP. And still the #1 goal was always the Mutual Mortgage Insurance Fund, but it was also to avoid those lengthy foreclosures, try to keep the borrower in the home if that's possible, and provide loss mitigation options, you know, as possible. So back then, you know, we had national and NSO pools and, you know, had modification. You haven't heard HAMP in a while, that word, that acronym, but modification programs for borrowers and so forth. So the program had an impact. You know, we did sell over 100,000 loans, and approximately 40% of those borrowers were able to avoid foreclosure. Some of them were able to reperform, and a lot of them were able to, 19% was able to get modified, as you can see. So that was then. So as you can see with loan sale, this is now where we're into HUD vacant loan sale. So the foreclosure crisis eventually worked its way out and it's over. And then HUD found itself in a situation where it had HECM loans. Those are a home equity conversion mortgage loan where the borrower and the eligible non-borrowing spouse is deceased. The property is vacant or it's abandoned and the heirs have not paid off the debt. So those are the loans we're really focused on selling today. I think there's a study that was done. I forget by the name of the entity, but you know, if your house is next door to or close to a vacant house, it's going to bring down the property value. So the government also has to pay to maintain these homes. So we need to get them through a foreclosure process, and one way to do that is to sell them and have our purchasers take them through the foreclosure process. So what's important to recognize about HUD vacant loan sales and why they've been great in terms of helping with the supply issue is that these are vacant homes, #1. Our purchasers have no choice but to take them to foreclosure. That's pretty much what's going to happen. They have, in some cases, been able to work with the heirs, but that's not always the case. They've done some deed in lieu and some short sales, but most of them go into foreclosure. And then our purchasers will now have control over some of that inventory through REO. Some will be sold at the foreclosure and others they will have in the REO. And it's the REO that we're focused on, what they do with that. And that's where our mission objectives come in. We have some characteristics here. They're about 58 years old. Most of these homes are on average and about 1,500 square feet. And based on census tract data, about 50% of them are in minority neighborhoods. So we started the HUD vacant loan sales in 2017. So far, we've had 9 sales. We started pooling them in regional pools and evaluate the bids at the pool level, but we wanted to increase the participation of nonprofits. So we now offer the loans in a national pool. So it's just one big pool and the nonprofits get priority bidding. They get to go in and cherry pick the loans that they want. They don't have to be the highest bidder. They simply have to meet our reserve price. They can buy a minimum of 5 loans. That's that minimum, except sometimes we have a one-off, but minimum of 5, whereas the for-profits have to buy at least 20. So we started with in 2019 with the priority bidding, where we offered 10 to 25 loans. Then we moved it up to in these 2017, 2018, 2019, that just means the fiscal year when we do the sale. And 1, 2, or 3 means the first or the second or third sale in that fiscal year. So beginning with 2019-2, that second sale, we increased it to 10%. And now nonprofits can buy up to 50% of all the loans that we offer in the sale. And the little table on the side shows each year the participation of nonprofits, how many nonprofits have won. Beginning with HVLS 2022-1, we had 11 winners, but 7 of those were joint ventures. But if you go down to our most recent sale, 2023-1, you see we had 10 nonprofits and there were no joint venture. Those were standalone nonprofits bidding on their own. And we've made some changes there where we don't give the priority to joint ventures anymore unless it's 2 nonprofits joint venturing or it's a nonprofit and a local government. So it's either a nonprofit and local government, or 2 nonprofits if they're a joint venture, but we don't give the priority to a nonprofit joining with a for-profit. And the reasons for that is we really want nonprofits who are mission focused. And that's something that we really look very closely at in the qualification process. So how are these loans being resolved? Mission objectives are very, very important. So as I mentioned before, since the borrowers are deceased, foreclosures, the resolution, the outcomes that we're going to see most takes about 16 months for a loan to go through the resolution process. We now have mission objectives that are focused both on supply and revitalizing communities and affordability. And purchasers have to report back to us in their quarterly reporting on what they're doing there. And beginning with HVLS 2022-2 Part 2, we instituted a first look where all purchasers have to offer the REO to first look offerees for at least a 30-day priority period. And it could be to a nonprofit, owner occupant, eligible nonprofit, or a unit of local government. And we get a quarterly post-sale report from each of the purchasers. So these are things that we're tracking that they have to report back to us on what's going on. So to date, we've sold 10,280, and we have a sale coming up December 6th. I think we have about 1,600 loans in that sale. 60%, we have resolved so far, 77% of these 10,280 loans have been resolved. Most of that, I guess, through foreclosure, but there have been some other non-foreclosure resolution. Our data showing us that nonprofits tend to resolve the loans faster, whether it's judicial or non-judicial, maybe because they're buying less loans, we don't know. That's something that we have to look more into, but loans are being resolved. And let me go back a little bit. What else I can tell you about that? 77%, yeah, 27% have been sold to nonprofits so far, and the rest have gone to for-profit entities. We also have direct sales. The commissioner touched on that this morning. We've been doing direct sales for a while, and direct sales will be part of the NPR that we're putting out, where we sell direct sales to governmental entity. So far, they've been partnering with nonprofits, but when we have our final rule and in the permanent program, I believe we'll be able to sell directly to nonprofits. And of course, Office of Management and Budget approval is required for all our sales, not just for direct sales, but they weigh in on the price when it's a direct sale. When it's a competitive sale, not so much. And so far, we've only done 4, but we expect to do more in the future. So loan sales over the years since its inception back in 1998 have been flexible. I've been able to pivot depending on whatever the housing crisis happens to be. And continue to evolve, and even with it becoming a permanent program, we'll still have the flexibility around what we're gonna do to help with whatever's happening, and also have a mission objective in addition to our overarching goal or our overarching objective, which is to bring money back to the MMI fund. So with that, I'm open to questions.
Fantastic. So the biggest one that I think everybody, at least I know I'm waiting for it, and the commissioner referenced it, is you're working on a proposed rule change, right?
Yes.
Are you under embargo? Can you let us know?
Well, we just had an evaluate, what's it called, the final step to it, I think, is to an impact analysis of the rules. So we've just completed that. So I expect it to come out very soon. You'll have a chance to comment on it. It covers single-family forward sales, HVLS sales, which are the HECM sales, as well as direct sales. And all the rules around those three types of sales. And it also has built-in consumer protections where those are necessary around like forward loan sales. And as far as first look, that's going to be a part of it as well. So we expect that to probably come out sometime or soon.
Sometime soon. That's
Yeah,
great.
so we're excited about it. And one thing I didn't touch on in the slides, but we're looking at, and we can't say a lot about it, although it does look positive, is around affordability. So some of our purchasers have reported to us the sale price of the houses that they're selling. So we've been able to look at these sale prices relative to the median home value in the different census tracts. And based on what we're seeing is that they're selling, whether it's to an investor or to an owner occupant, these homes are selling for less. And we have some numbers, but I'm not going to give them out because we have not like really vetted our methodology yet internally, but it does look positive. And with respect to the affordability piece, we've looked at the ones that are sold to owner occupants. So we've only looked at a little over 1,200 loans because those are what we had data for in terms of the sale prices. But we were about more than half of those, almost 700, were sold to owner occupants.
Mm-hmm.
And with those, we've been able to calculate based on today's underwriting standards, the PITI, the principal, interest, taxes, insurance. And based on what we're calculating, they look to be below the 30%. So we are excited about it, but we have to present that to our leadership and go over our methodology and the data before HUD can come out and be, much more specific and say that this is really what's happening.
Right, right.
Yeah.
So we do have some questions from the audience. Molly, we're going to come back to you
Okay.
because people are asking about the investors in flipping, of course, right?
Right.
So multi-part question. What is the median length of time that an investor holds onto a property? Was the first part. Does CoreLogic track the change in property holding time over time? And with market effects, is 6 months the appropriate length of time to define as a flip? So how do you
Okay,
define a flip?
Yeah, so I don't have an answer to the median time investor holds. So yeah, we look at 6 months or less for the property to sell as the flip. So I guess you're saying, I guess the question is maybe we could extend that a little because, takes a little while to fix things up. So
Right.
yeah, I mean, yeah, that's a fair question. Yeah.
Sure.
Yeah.
Sounds good.
Mhm.
So let me jump to Melissa. So what is the benefit of a seller using Zome's auction platform, and do they have any incentives to accept bids in the first 30 days? So I'm a investor or a GSE.
So do they have any incentives to
Yeah.
accept bids within the first 30 days? Incentives to the buyer or incentives?
I didn't specify, but I think, so I guess I would reword it maybe as what are the benefits of an investor using your platform?
Sure. So benefits are a marketplace, right? So I mentioned 1.5 million site visitors each month. We're constantly driving traffic to your assets. We syndicate to sites like Zillow and all the applicable real estate sites to drive as much eyes to your assets as possible. We also launched a seller self-serve portal. So if you're not a huge mortgage servicer that has, lots of properties to list with us, you can actually load an asset yourself on our site. Obviously, we're going to have oversight and we're going to make sure things are done properly and we're going to have a conversation. You're not completely on your own. But we do have a seller self-serve portal where you can identify auction as a good disposition strategy for you and self-serve on the Zome.com site.
Sure. So I have a question for three of the panelists, Melissa, Matt, and Marlene. Can you describe messaging strategies to low-income and moderate-income buyers who are in need of these services and programs? We'll start with Melissa.
Say it one more time.
Yeah,
sorry.
sure. Can you describe messaging strategies to low-income and moderate-income buyers who are in need of these services and programs?
So messaging. So, I mean, I would say like messaging is that our average sales price for a post foreclosure asset is around 150,000. So our platform in general is a good source of supply and inventory. I would say messaging, like Matt referenced earlier, there are some things to be aware of. This is distressed inventory. You need to make sure that you have the ability to rehab that property or have partners in place who can help you rehab the property. Financing is another issue that has to be solved for. If the property is occupied, that's a real a cause of concern. If it's vacant, then there could be an option for financing. Absolutely, especially if you purchase during the first look period, because one thing that the first look program did is it actually lays out to servicers that, hey, you have to provide access during the first 14 days. If somebody asks for an interior inspection, if they want to go by the property and see what it looks like, you have to allow access. And that was a problem. I mean, I've been in real estate auctions since 2007. And during the financial crisis, I was an asset manager. So I remember advocating, like, we should let people into the properties to see, like, they should be able to buy the inventory. But what you would run up against is that there's liability, there's real cause for concern for mortgage servicers to allow access to an individual, right? So yeah, the first look program thankfully lays out a process for a homeowner or a nonprofit to be able to inspect that property. Hopefully I answered that.
Matt?
So I think a lot of the same things that Melissa said. I think the auction vendors do a good job of buyer education. So the two largest auction vendors I know sometimes will go into areas and have probably there's a bigger inventory flow, but they'll go into areas, let's say a certain MSA, that there's quite a few properties that are available, and they will go in and have buyer education programs. So it'll show these owner occupants the help with the nonprofits, all these different education things, such as financing, bring in a rehab contractor to say, these are the pitfalls that you need to watch for. Because I agree with Melissa, especially on FHA properties, they are conveyed broom swept, so they're not fixed up properties, and they're safe and sanitary, but there's probably some work to be done. So, I mean, sometimes it's a daunting task for a owner occupant to get in there and maybe rehab these properties. So I think those education seminars that they put on the websites, things like that, are very, very good for the owner occupants. I think also to understand that in an auction, there's a reserve price. So the way HUD does it, I had kind of set up the CWCOT program when I was at HUD, and what happens is you look at there's a haircut. So let's say that in Texas, that the haircut is 20%. So the lender goes in and gets a fair market value appraisal prior to the sale. Let's say that's set at $100,000. So I can do math this way. And so the haircut's 20%. So if they get a bid for $80,001, they can sell that property. So the theory is it gives some equity for the buyer, investor, whoever, to not, have to pay full retail for that property, but have some wiggle room, so to speak, to be able to do some repairs to the property, things like that. So you don't go into a property where you have a negative equity situation. So I think those are some of the things that they need to understand about buying these properties. If they don't do their homework and have a good realtor that they can work with, things like that, it could be a daunting task, but it's also can be a rewarding situation too for a buyer to buy these properties and maybe get into an area neighborhood that maybe they potentially couldn't afford otherwise.
So messaging, so we're not selling direct to
Right.
consumer. So we're selling to nonprofits and of course, investors. Now, for the little bit of research that we have done on the sale prices, it looks like in terms of the sale price relative to the area median home value, it looks like the better properties may be going to the owner occupant, and the ones that need fixing up are going to investors. So that looks, we need to look more into that, but it looks that way. But we're looking to our purchasers really, and so within the CAA, in our first look program, we built in language around allowing time for due diligence, for purchasers to do their proper due diligence, so they can decide, if this is the right property for them. And I think once we have our rule out and we're able to do direct sales, the way the direct sales will work is purchasers, nonprofits or units of local government, they have to come in with a plan. And within that plan, those are some of the things we'll address. How will you promote these to owner occupant buyers? What are the incentives, things like that. HUD will be reviewing that, and the ones that come in with the best plans for mission-based outcomes would be the ones we would be entertaining to do direct sales with. So the messaging, really, if you're a buyer, if you want to know who purchased from us, we can certainly provide that to you. And you can go straight to that nonprofit or that for-profit and ask about the First Look program. But we're leaning on our purchasers more through the CAA, that's their contract with us to do certain things to make sure that these homes get into the hands of minority buyers or whoever is looking to buy a home.
Right. Thanks, Marlene. So I think the next one is back to Zoom and HUD. So how important is collecting data when conducting these sales? So you're collecting data on a quarterly basis.
Yes, we're collecting data on a quarterly basis. And then we are also not evaluating the data, but validating the data also quarterly. We used to do it annually, but we're doing it quarterly now because we found that when you wait annually, sometimes the servicers, people change in the servicing shop and they don't remember what they sent you, a year ago. So now we try to sync it up. So it's very, very important to us to collect the data because that tells us what the nonprofits are doing, what the for-profits are doing, what the outcomes they're meeting, and whether or not the program is having its intended mission goals and meeting those mission objectives. So data is very important.
Is that reporting for the life of because some of them may.
Yeah, it's for 4 years.
Okay.
And then if we want, there's a period of time where HUD can go back and get updated data. I think that's for another 2 year. This is our compliance contractor.
Right.
Another 2 year period. And we've gone back out on DASP to get additional data that we didn't get the first time, even though it's over, but still it's in the contract so the government can do that.
Great.
Yeah.
Is Zone collecting data?
Sure, data is life, right? Yes, I mean, there's several different facets to that question, but we're collecting data, of course, on First Look success, who's purchasing from us, what the average sales price is, how long did it take to close, how many contracts fell out. I mean, those are all things that we're capturing. How long does it take to close the property? And then there's also the other side of that is, we're reporting monthly sales results to our clients. What's Texas doing? Like what are foreclosure sales? What's happening at foreclosure sale in Texas? What's happening after foreclosure sale? Are we starting to see, some concern? Are investors pulling back or at foreclosure sales specifically? we're constantly socializing data with our clients to set expectations for, future forecasting.
Great. So Marlene, can nonprofits pick and choose the location of the HVLS when purchasing, or do they need to be in a specific region? And then follow up is, what are the current downfalls, areas for improvement of the program?
Okay, so the first question is easier.
Yep. I know the answer to that one, so but you can go.
Yes, nonprofits can pick, we have one national pool and the nonprofit can pick whatever they want, wherever they want it. Okay,
Yeah.
so the second is how we can improve. Well, for one thing, we need to get our rule out.
Yeah, that's exactly, yeah, so.
And make it into a permanent program. And so we're looking forward to your feedback when the NPR comes out, because, as Commissioner Gordon said, it's important for us to get feedback before we make anything final. And so we're looking forward to that. So whoever asked that question, you have your opportunity when it comes out to read that long document and tell us what you think, and we'll consider all that in.
It's not going to be as long as the CRA.
No.
Okay, good.
No. No.
So another one for you, Marlene. They seem to like the HVLS program. So in the HUD note sale process, when there is a nonprofit / for-profit joint venture, the JV is normally the vehicle for the nonprofit to access the capital needed to participate in the sale. Could providing the preference for JVs disadvantage smaller, less capitalized nonprofits?
Well, it didn't seem to have that impact in our last sale because we had 10 nonprofit
Mhm.
winners. We realized that nonprofits need capital to buy, but it's not even so much about nonprofits partnering with and buying a lot of loans. It's nonprofits who are really mission focused. And that we know when we get these loans in their hands, it's going to go back out to an owner occupant purchaser. And they're not necessarily, the way we define nonprofit joint ventures is that the joint venture was created to carry out the nonprofit's mission. When we evaluate the nonprofit standing alone, we're evaluating them on their housing mission. And we know that we're selling it to a nonprofit. So they're not just coming together, creating this joint venture just because the for-profit might want to get their hands on some loans and this is a way to do it. We know that that nonprofit is focused on its mission of housing. So if it buys 10 loans, those 10 loans are going back out as affordable housing. And if it buys 100, then that's what's happening. And
Right.
Yeah.
So off the top of your head, do you know what the buyer profile looks like of somebody that wants to purchase in the HVLS, right? Like,
Yeah.
what are there minimum qualifications that they need to meet in order to bid on the?
Yeah,
pool?
it's a self-certification process. So for nonprofits, they have to have net worth, I think, requirement of $3 million. But there are other ways they can do it. If they don't have that net worth, they can get a letter of credit. Help me out. Letter of credit. I can't remember the exact language, but there are different ways that they can meet that net worth requirement. But they're self-certifying to everything, but they also have to have been a nonprofit for at least 2 years. If it's less than 2, they can come to us, not to our contractor, but who qualifies them, but directly to HUD, and we can look at their background and see how long they might have been in the housing space and what they've done, and we might be able to make a waiver on that 2 years. And then they have to have the IRS codes that say that this is their mission and it's housing. And so we evaluate all of that. So that's what a nonprofit, it's kind of, that's about the gist of it in terms of what the qualification process for a nonprofit.
And the for-profit is what, just out of curiosity?
The for-profit has to have a $5 million net worth, and there's no way around that. And but whether you're a for-profit or a nonprofit, the mission objectives applies to everyone. Okay.
And they still have the same reporting requirements as well, right?
Yes, and the same. It's just that we give the priority bidding to the nonprofits. Yeah.
Okay.
And it's because of that priority status why we went to making sure that the nonprofit was truly a nonprofit that's really mission focused.
Okay.
Because they're getting a priority, and we only wanted to go to them.
Great.
Yeah.
So last chance for questions, online and in person. My screen is, nobody's typing on my screen, which is pretty intense, by the way. Don't pay attention to who's typing. So if that's it, yeah. So I want to welcome, well, actually, I want to thank everybody on the panel. First of all, thank you so much
Thank
for all
you.
your insights and information. And I'll bring Yannicka back up to the stage for final remarks.
Thank you. I'm here just to close. I'm really closing on behalf of NCST and the Urban Institute. I'm just reflecting that I started the day off